your 20 million entry point would have been 5 million just like 15 years ago. So
Yeah.
20 is the new 5 for, the pre-A late stage seed company.
We've tried to enter, I'd say, sub 35 on pretty much everything we've done. I think, our weighted average entry point is like a 20 million post for our deals. We're starting to see that, your blue chip founders, your exited founders. I think the starting point for a lot of these YC companies, the valuations have been creeping up more and more, especially in recent months. And so we're paying attention to that and just trying to make sure, hey, look, like when a buyer comes in here, we know what buyers pay. They're not what VCs pay, and so we've got to be really see a path to true revenue growth after we're entering to make sure that we can kind of right size things and get the right outcome there.
We once had a portfolio company that we introduced them to a strategic CVC. Then the corporate started paying them $5 million a quarter, and they had nothing but like POC type revenue. Nothing had converted to enterprise. So all of a sudden, out of nowhere, they went basically from zero, to 20 million ARR. And then people were disagreeing from the East Coast to the West Coast at the time, saying like, I think we should raise 10 on 40. So we have a 50 million post. So if we get acquired for 200, we could take it. And then others were like, no, we got to raise 100 on $1 billion. And I was like, yeah, but who's going to buy this for $4 billion? And the only exit would be an IPO, So it's quite interesting how you limit your options when you raise too much. Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today we're with Arvin Grover, who is the founder and general partner at Digital Health Venture Partners. Arvin, good to see you again.
Andrew, good to see you. Thanks for having me on.
Yeah, so Arvin and I recently had Arvin on my VC panel at an event that I was doing in Washington, D.C., in the beautiful office of Foley, so that we had a good time there. So we're kind of going for round 2 here. Awesome. So Arvin, why don't you start us out and tell us, what does Digital Health Venture Partners, or DHVP, do?
Yeah, no, thanks. So we're an early stage venture fund. We're focused on healthcare software and AI enabled services, and we're pretty focused on investing post product market fit, but pre-Series A. So we thread a pretty tight needle. And what's core to our model is we have a focus on bringing in customers during our diligence process, but then post investment, where we can really go out and add value to the companies that we're investing in. And I think, a lot of people say that, but I think the way we do it is we've got an LP base of some strategics, exited founders, and ultimately what we're able to do is, actually diligence the companies with buyers, understanding, why they might want to buy something, what they're using in the market today, what type of ROI they're really looking for from a solution. And so we feel that we're able to de-risk investments by establishing that up front before we get involved. And then, also it creates access when you can bring buyers to the table. I think in competitive situations with rounds, where we're able to wiggle into competitive offerings just based on our ability to bring in these customers. So that's really what we're doing, and happy to answer any questions on that.
Yeah. I would say we're quite similar. A lot of our LPs are exited founders and strategics, or alumni, or still at a relevant corporate. And I call this due diligence and seduction at the same time. So just like you need to seduce somebody to marry you or whatever, in a competitive deal, you want to seduce the startup to allow you to be the lead investor or co-lead, or even just get in there at all. And if the due diligence actually puts them in direct contact with a prospective customer distribution channel, they start, rating you a bit more highly. And even if you don't invest, they might tell their friends, like, I'm sorry I didn't get these guys. If you can get them, they're good. One of the benefits of having a diverse LP base. And so going a little deeper into stage, so you're probably not investing in a pre-revenue company, even with a repeat founder, or you're having what's your minimum kind of level of traction, or even if it's defined as MRR or something like that?
Yeah, that's a great question. We think about that a lot. I would say there's no hard and fast minimum. I would say that we've got to be able to talk to at least a couple of pilot customers, enterprise customers who have made a buy decision. We've got to be able to understand why they made that buy decision. And if it's, to your point, if it's a repeat exited founder that we have a lot of confidence in, if we can validate with our network that they would be buyers of a solution like this, and they can get close enough, and we feel that maybe we can be helpful in bringing in the first customer, bringing in the second customer, that can oftentimes be enough for us to get involved. I would say that that's less often the case when we're investing. It's typically a couple 100,000 of ARR to maybe 1 million of ARR, and where the company's been operating and selling for a little bit of time.
So on an ARR or monthly basis, what would the minimum be?
I would say typically, north of 250 in ARR, ideally 500K in ARR.
Okay. Okay. And geographically, and you're based in Washington D.C., right? So geographically, where are you open to investing?
We go where the deals are. So everything's within the United States. We won't do anything internationally. But ultimately, our process is such that we're finding companies and we'll say, okay, we like what this business is doing. Let's go evaluate who else is in the space and who else is out there. And so that exercise might lead us to ultimately investing in a different business, or we might just ultimately want to see, okay, who's out here? Is there anyone who's really overfunded, has raised a lot of capital, or has someone been doing this for a while? So that kind of market mapping exercise ends up taking us all over the country.
Okay. And your digital health venture partners, not medical device and drug discovery biotech venture partners. So maybe describe within the healthcare world, what are you not? And then maybe what are the focus areas?
Yeah, no, great question. And I think we chatted a little bit about this on our panel, and had a similar view. But we feel that a lot of times drug discovery, anything that requires like medical devices, anything that requires FDA approval, that's really not what we do. We're not going to take any binary risk there. Those can oftentimes be very capital intensive businesses, and oftentimes you're not even focusing on building the business part of those companies for a very long time. So we tend to focus solely on software. We do a lot of AI tech, and we will do some AI enabled services. So that's less often of what we'll do. But there's got to be some kind of technology component in the business that we're investing in. And so typically these companies are selling to hospitals, health systems, health insurance companies, self-insured employers, health insurance brokers, and just broader provider groups. So that's kind of how we view the world and where we're playing today.
So it's probably more HIPAA compliant in many cases, but not FDA approved.
Correct. Yeah. Certainly, when we're touching patient information, HIPAA compliance is a big part of that. But yeah, I'd say that's accurate.
Okay. And what are your thoughts on portfolio construction? So roughly how many companies are you planning on investing in this fund? And what are you up to now on investments made out of this first fund?
Yeah, so we did a couple SPVs before we got started, but Fund One, we now have 15 companies in the fund, and our target is right about 20 companies. I think that's the right number for us. Really, where we feel we're getting enough diversification, but then also having a good enough size in each company that if one of them hits in a big way, it has a material impact on the fund.
Okay. Okay. That sounds good. And roughly how many SPVs did you do beforehand?
We did two before we got started.
Okay. Okay. You're better than me. We did a lot of SPVs for a while, and it was very like events. We put them on stage and get people in the room, and a lot of the VCs are just going directly on the cap table. We said, all right, that's fine. It's hard to complain and not get circumvented, but then we managed to turn that into Fund One. That was a long time ago for us. At one point, I think we've done 70 SPVs, over the years. Some of that is, most of that was after having a fund and saying, okay, the fund did this, but the fund's not all that big. We have the ability to put in more money. And so, we just said, if you're in the fund, you can be in an SPV, I look forward to the day when I'm not doing so many SPVs. Being totally honest, about all that. Okay, and so geographically, are there any clusters and parts of the U.S. where most of the deals are? Like, kind of like, what's your 1, 2, 3, 4 market where most of these 15, or are they equally spread out?
Yeah, it's a great question. I think 7 or 8 of them are in New York.
At least you're in the same time zone. It's not very far away to New York. That's cool. And if you're investing at that kind of pre-Series A stage, what do tell LPs, or what is your perception on holding times? Like, and what's your expectation on how long between entry point investment to even, or let me start this. How quickly do they get to a Series A if you're investing before the Series A?
Sometimes it's as short as 4 or 5 months. But I think what's interesting about our strategy, and we'll see how it works out for us. But so far it's going very well. I would say this whole idea of investing post product market fit has been really interesting, because we did an exercise recently of tracking the whole, like, how long we looked at a company before we pulled the trigger and made an investment. And there were certain cases where we said, okay, we're looking for a company, an AI driven chart review. We want to see this sort of customer base, want to see this type of traction. And so we're running a search for a business. When we found one company, we said, okay, bullseye, direct hit. We're going to go and make an investment in this company. I think in that case, it took us maybe a month to get to conviction and pull the trigger on that
And you
deal.
found this with outbound, like you mapped the industry, and you found a company, and you basically cold called them.
Exactly. Yeah,
I love
exactly.
it. Okay, that's great.
And no, appreciate that. So yeah, we were running a search in a category, and so that company, we said, okay, we got conviction very quickly, met the founders, loved the way they were thinking about the business, and so there we moved pretty quickly. In other instances, we've said, okay, we like this company, we like this team, we think there's something novel here, but we just don't see the proof in the pudding just yet. We want to see a little more traction. And so in some cases, we've tracked companies for 3, 4 years before pulling the trigger there. And so we tend to say the magic happens after PMF. So you're seeing those rapid up rounds, you're seeing those acquisitions start to happen. And so in some cases, when we've tracked companies for over a few years, we had one acquisition happen in 12 months, another one in 15 months. And so we tend to think that by waiting for PMF, you're going to see shorter hold times and faster up rounds.
Yeah. I mean, I always say spend 30% of your time doing other people favors, because your remaining 70% should have at least a 2x multiple on effectiveness. So 2x 0.7, you're at 1.4 above your 1 flat. But with what you're doing, if you're making an introduction to a angel group or an individual angel and raw seed investors that are investing in lots and lots and lots of companies, by the time they hit the point that you want to enter at, this PMF product market fit point, hopefully, you've got some lad points with them, and they're going to let you invest or let you lead, if you introduce them to customers and distribution and stuff and investors. That's cool.
100%.
And as an emerging manager, so rather than spinning out of some Sequoia Dynasty fund, some of these companies get acquired quicker than you might have thought. And you're faced with a decision of, do I take the cash now that the stock has been sold and distribute that to LPs, or do I recycle it back into the fund balance sheet to be reinvested into other opportunities? We were talking about that on the panel in DC. What's your policy on that now?
It's a case by case basis, I think. But I think we early on in the fund life cycle, I think we're kind of we're thinking about, okay, we should be recycling some of this cash, putting it back to work, and really kind of generating as much as we can for the broader portfolio. I think as we move towards the end of the investment period, I think that becomes a little less likely the case. But we kind of view it on a case by case basis, and kind of saying, okay, are we getting the right returns here, and are these the outcomes we want?
Okay. And as we talk, maybe shifting gears to valuations, and it feels like, Sam Altman speaks or gets a rude question and the whole market shifts. But what is your sense on, maybe giving an example, if a company's got 1 million of ARR and you're calling that PMF, product market fit. Somebody else's, their definition of product market fit is much more like should have already IPO'd. But what if it's 1 million of annual reoccurring revenue? You've just kind of crossed that point, and it's probably got high growth. What do you think a pre-money valuation should be, or the cap on the safe note for a good AI company addressing the healthcare sector?
Yeah, I mean that's a great question. The $1 million question. I would say it's going to depend on a variety of factors. I would say how fast is the company growing, like month over month for the last few months, and what they're projecting to do, like how much is contracted. I think all plays into that. I think we're seeing a lot of AI companies now. They're pricing like SaaS, and they're not pricing on utilization basis. So sometimes the gross margins are not really where you would typically imagine for a software business. So we're looking at the gross margins, we're looking at growth rates, but I've seen stuff anywhere from 15 all the way up to 35 and in sort of that range right there. So I would say like
So you're definitely not seeing 10x.
Yeah, we're not seeing 10x for AI companies right now, and I think it's a case by case basis, I would say. So we've tried to enter, I'd say sub 35 on pretty much everything we've done. I think our weighted average entry point is like a 20 million post for our deals. So I mean, we're trying to be thoughtful about it, but there's definitely been some stuff we've seen where the valuations are getting a little carried away, and we're starting to see that your blue chip founders, your exited founders. I think the starting point for a lot of these YC companies, the valuations have been creeping up more and more, especially in recent months, and so we're paying attention to that and just trying to make sure, hey, look, like when a buyer comes in here, we know what buyers pay. They're not what VCs pay, and so we've got to really see a path to true revenue growth after we're entering to make sure that we can kind of right size things and get the right outcome there.
And this fits into the calculus and like the decision making equation, but do you invest at that stage pre-Series A and that's it? So it's like single shot, or are you reserving 30% or even more for follow-on and like double down into the winners? What's your portfolio construction with regard to reserves?
Yeah, it's a great question. And yeah, you kind of hit the number on the head. We're kind of reserving right around 25% for follow on, and so we've been optimizing for ownership at entry. We've just been seeing that early on we made some smaller bets and saying, okay, if this takes off, we'll double down here. And I'd say that we're seeing deals come in at 3-4 times the price on the Series A just a couple 12 months later, and so. For us, it's really about, all right, A, do we have conviction in the business? And B, is this still a valuation where we think we can drive 10x returns? And so, not that we have a crystal ball, but if something's pricing in the 200s, it's harder for us as a small fund to say we're really going to double down because our dollar just doesn't go as far there.
Right. And how much dilution are you expecting on a company that is really going to take off? Like, so you're going to be diluted probably 20% in the Series A, right? If you're not participating, and maybe you double down on that. Like, how many financing rounds and what kind of dilution are you kind of modeling and underwriting for?
Yeah, we're modeling in roughly 3 rounds, so like roughly 60% dilution is what we're anticipating if we don't put anything else in the business. And I think there's a lot of companies raising a lot of capital these days, so I think we just also we're trying to stick to founders who are a little more capital efficient, because getting in early is not always a good thing if you raise too much money down the road. And so those are dynamics we're cognizant of. But yeah, I'd say we typically anticipate 3 rounds, and I think we are seeing some nice acquisition activity in some of the earlier companies now with all that's going on in the market with AI. So that could be a little bit of an aggressive assumption, but we kind of err to be conservative.
So if entry point is 20 and you were to make a 10x return with no dilution, then you'd need to exit at 200 million, right? And if you're getting 50-60% dilution along the way, you're looking at like 400 million type exits to make a 10x. So that's probably realistic. What do you think the range of exits are going to be? Because there's certainly been inflation in the market capitalization of Microsoft and Apple and, Oracle and all these companies.
Yeah, it's something we think about a lot. So, I think it's Sante Ventures that has some good data on this, but like for healthcare specifically, healthcare IT, I think it's like the average healthcare exit is like a 350 million, $400 million exit, and so I think what that means is we are not banking on billion-dollar outcomes for every company we invest in. I think we're trying to say, okay, can we make 10, 20x's by not making betting on a unicorn? And so I think that's kind of what we've been doing, and I think what we're seeing in the market is you've got a lot of acquisitions kind of in that range, but then it's just there are only so many acquirers after a certain point who can come take you out for $1 billion. So I think your optionality is a little better with some of those more mid-size exits, I would say.
Yeah, we once had a portfolio company that we introduced them to a strategic CVC. Then the corporate started paying them 5 million a quarter, and they had nothing but like POC type revenue. Nothing had converted to enterprise. So all of a sudden, out of nowhere, they went basically from zero, to 20 million ARR. And then people were disagreeing from the East Coast to the West Coast. I was West Coast at the time, saying like, I think we should raise 10 on 40. So we have a 50 million post. So if we get acquired for 200, we could take it. And then others were like, no, we got to raise 100 on $1 billion. And I was like, yeah, but who's going to buy this for 4 billion? And the only exit would be an IPO, So it's quite interesting how you limit your options when you raise too much, And I think if you count how many companies close a Series A, like get a number, how many companies exit for over $1 billion, and what's the percentage chance of getting that exit? It's pretty low. I think we're going to see it increase.
100%.
I mean, it's kind of tough because, you're talking about your 20 million entry point would have been 5 million just like 15 years ago. So
Yeah.
20 is the new 5 for, the pre-A late stage seed company. Well, why don't we do this? Are there anything else that you think people should know about digital health venture partners to get to know you, or how to reach out to you if they want to get in touch?
Yeah, LinkedIn's an easy way to get in touch with me. My email is on there as well, so that's pretty easy. And no, I think it's an exciting time to be in healthcare AI right now. I think Menlo put out some data recently that's kind of showing the adoption rate for healthcare AI is like 22%. The broader economy is at 9%. So I feel like this is
Wow.
the time for healthcare AI. I think everything's starting to move in the right direction, and I think it's a great opportunity.
Well, it's so good for humanity that it's happening. Like I think we invested in Taxo, and I think you invested in a competitor to Taxo. That's the one where, you go into your primary care provider and say, does my health insurance cover me for all these scans or whatever? And they tell you, yeah, you're covered $0. Like this happened to me. And then they go, you get the scans, and they tell you, actually, we messed up. You owe us $9,000. And like this is kind of like AI to take the unstructured data and put it in all the different API systems and tell you exactly the thing. And so we're not wasting any money now on somebody investigating that question and failing, Like I jokingly say it's like Pablo Escobar puts the money in the money counter and goes and it counts the $20 bills and it doesn't make a mistake, So to get rid of a little bit of bloat in the healthcare system would be amazing. So hearing 22% adoption compared to what, 8, 9 for the rest of industry,
That's right.
that is welcome news. God knows it's bloated and it needs to be done better.
100%.
Well, cool. Yeah. So I guess in closing on that, it's kind of a double bottom line of an opportunity to make a lot of money while, fixing a very badly broken system that has a lot of room for improvement.
Yeah, 100%. I think if you're seeing what's happening in the insurance space, I mean, a lot of premiums are rising, especially for self-insured employers and groups like that. So I think it's time for spend to be cut out of the equation. We're seeing what's going on with PBMs. We're seeing what's happening across the board. So I think the whole motivation now is to squeeze out some fat from the system here.
Okay. Well, I'll put your contact details in the show notes, but if anybody wants an introduction to Arvin, I'm happy to do that. And if anyone's coming to Art Basel, we're going to be together for a couple of days in early December. And at the next Global VC Demo Day, you can meet Arvin in person on December 4th in Miami. So Arvin, thanks so much, and I'll see you in a couple of weeks.
Awesome. Thanks so much, Andrew. Looking forward to it.
Okay. Bye for now.